Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow, and today I'm speaking with David Keller, the CMT and chief market strategist at stockcharts.com, as well as the man behind the Final Bar Market Recap Show. Welcome to the podcast, David.
Yeah, it's good to see you again, Mike. How have you been? All right?
I've been great, and thank you so much for taking some time out here to chat. You know, it's funny, the last time we talked on the podcast was July of 23. S&P was trading for about 4,400 then. Here we are at 5,200, give or take now. I'm wondering how your broad market outlook has or really hasn't changed since then, given what we've seen happen between those times.
Yeah, it's really interesting. I mean, when you think about how the market has evolved over the last, 6 to 12 months, I mean, there's, obviously distribution going into a major low last October, but then coming out of that October low, everything felt different. And I would say here at the end of the first quarter, here as we're wrapping up March, things are evolving yet again. So October, November, December, January, even February is really a growth-led bull market phase. All right. So the primary trend is higher. It's the growthy stuff, semiconductors like Nvidia, AMD, Microsoft, Meta, these sort of mega cap names really doing the lion's share of the gains. But I would say in the last 6 weeks or so, you've seen a broad rotation, right? So you're seeing days where consumer staples, even like food products, some of the beaten down names that have really been underperforming are starting to improve. So I think this is part of a broad rotation away from some of that growth leadership and really giving space for some other sectors like financials, industrials, even basic materials to start to improve. So for stock pickers, I would say it's a pretty ripe environment here as we wrap Q1.
Great. I'm definitely going to talk a little bit about sectors, but I want to ask you another thing about the broad market here first. You had a comment recently about the percentage of S&P 500 stocks that are trading above their 50 and 200-day moving averages. I kind of found it interesting in whether or not that was a topping signal. So I was wondering if you could elaborate on that.
Yeah, so one of the ways you measure strength of a market, right, besides just looking at the price and is the market going up? And by any trend following definition, the S&P and the Nasdaq are in primary uptrends, right? They keep making higher highs and higher lows. But breadth conditions allow us to look underneath the hood a little bit and just think about what about all the stocks that comprise those indexes? Are we seeing any differences between the benchmarks and those names? Breadth indications overall have been improving pretty consistently, right? And what that shows you is, again, it's sort of all the other stuff, right? The banks and other types of names, heavy construction names and other things are starting to break out. And as a result, breadth data, breadth numbers are remaining pretty strong. So when you have about 80% of the S&P 500 stocks above their 200-day moving average, that's a primary bull market. That means most things are kind of going up. And you want to be concerned when stocks are starting to break below their 50-day moving average. You're really not seeing that in any meaningful numbers. So we're still up in about the 70-80% range of stocks above their 50-day moving average. That starts to break below 50%. That would be sort of a let's reassess, let's think about whether it's more of a risk-off environment. But for now, those strong breadth readings really speak to the fact that it's not just the mega cap names anymore. It's kind of a lot of things that are really starting to participate. I would say that's probably one of the more bullish pieces of evidence we could cite here.
Okay, got it. You know, if we zoom into the shorter term, one of your recent videos on the Final Bar, you were talking about how we've had a few of those sell-off into the close kind of days as we head into the end of the first quarter. Any thoughts on that? Is that something to, sort of file away in the worry department or not really?
So before everyone thinks I'm super bulled up by all the comments I've made so far, what you have to remember is when the market's going higher, I think it's healthy to be a contrarian, have a contrarian hat that you put on and just think, what would I need to see to tell me things might be changing? And when I think about a bull market top and some of the consistent patterns you see, one of the first things you see are what are called bearish divergences, really bearish momentum divergences, right? Where the price is going higher, but you start to see weaker momentum. And what that means is you're actually starting to see some distribution days. An indicator like RSI is really measuring the average up day and the average down day. When that indicator rolls over a little bit, it tells you you're starting to see some distribution. And as you mentioned, going into the close, Mike, last couple of weeks, you've seen a lot of weaker closes, implying that institutions are actually selling that recent strength in the market. So bearish divergences right now for the S&P, for the Nasdaq 100, even leading names like IBM that have made new highs in March, but on weaker momentum, for me, are a bit of a red flag. And while I'm not seeing any significant breakdowns yet, I really have some clearly defined levels of risk on stocks that I've been following to identify when I might want to start to lighten up or think about more taking some risk off the table. For now, again, no breakdowns, but you're seeing some of those early warning signs, and the distribution going into the close is usually not a good sign for consistent gains beyond what we've seen.
Yeah, okay. Let's now talk a little bit about, that sort of rotation from a Mag 7 market to other sectors playing catch up. It's kind of interesting. I was just looking at year-to-date statistics for a number of ETFs. Financials are beating tech. Industrials are beating tech. The Homebuilders ETF, of all things, was beating tech by, like, I don't know, 5 or 6 percentage points.
Yeah.
Talk a little bit more about that. Where are you seeing these other groups start to play catch up?
Yeah, so I routinely scan for stocks making new 3-month highs and 3-month lows, and it's a good sort of working list of things that are moving, right? What's moving? And let me start to think about it. You've mentioned some of those key groups. Some of them have been doing well for quite some time, right? Like heavy construction, a lot of industrial names, railroads, commercial vehicles. These are all groups that have done quite well. But now you're starting to see like airlines breaking out. You're seeing home builders, which had really good rallies, kind of stalled out a little bit. The home builder ETFs, even individual names like Lennar and Toll Brothers, are making new 3-month highs. And so you're seeing a resurgence of uptrends in areas of the market that are really more value-oriented sectors. Banks like JP Morgan, Citigroup, Bank of America, all sort of breaking out to new swing highs. So generally speaking, I was taught it's always a good time to own good charts. So having a consistent process of identifying some of those areas of the market showing new strength, ideally the ones just starting to break out of bases. And what I'm encouraged by here at the end of the first quarter is I'm still finding those, regardless of what you think about the broader market and how it might be a little overextended. I'm finding stocks that are just breaking out. And I think that's encouraging. As long as you still find those ideas, I think there's opportunity to outperform.
Got it. On the flip side, again, let's kind of talk about, this Magnificent Seven group seems to be shrinking by the day. You highlighted the chart that everybody either owns directly or indirectly, and that's Apple, right?
Yeah.
What are you seeing in some of these big cap names, Apple in particular?
Yeah, I think it's air quotes around magnificent these days, right? I mean, it's less and less of a homogenous group, and that tells you when you think about the leadership rotation. I think that's one of the key tells. Is not too long ago, it felt like those 7 or 8 names were kind of all the same, right? You could use them interchangeably, and the charts were all the same. Tesla broke down first, really, at the beginning of this year. Apple really followed suit. And if you look at the last 6 months, I mean, Apple's been a sideways at best sort of chart, right? It's more range bound, stalled out at $200 a share, has continued to pull back and test support sort of in the 160s, 170s. And what concerns me about a chart like Apple is, again, it's following very well the checklist of what I would normally expect to see at a major top, right? First, in the fourth quarter, you saw Apple making new highs, but on weaker momentum. That's that divergence I mentioned we're seeing now on the QQQ. That was happening, November, December of last year for Apple. Then you saw those initial sell-offs. Now it's actually testing price support. I think if it breaks much lower, you're actually making a clear pattern of lower highs and lower lows, and talk about diverging from some of the stronger names like Meta and others, but even home builders and insurance stocks and others that are in these nice uptrends. Apple looks very, very different. And I think one of the key ways, Mike, to tell that is to look for relative strength or relative performance, right? Apple's relative strength line has been going down, and that really tells this story. If you want to outperform the S&P, you want to own stocks that are outperforming the S&P 500 simply, and Apple just hasn't been getting it done. So get excited about a name like that when it's able to show signs of accumulation. For now, I'm really not seeing that yet.
I've got it. You also recently commented that plenty of stocks are overextended after long bull runs, but others are just getting started. Is there kind of like the perfect example of the former and the perfect example of the latter if you look at individual names here?
Yeah, I mean, I think those sort of overextended names, we mentioned some of the mega cap leadership names like a Meta, like an Nvidia. I think if you compare, the chart of Nvidia versus the chart of AMD, you can see the risk, right? AMD's sort of chopped out a little bit and is broken down a bit. And I think that's the risk of names that have had exponential rises. SMCI, super microcomputer, probably the best example of the euphoric rise, right? The exponential gain, and then it comes down very, very quickly. And the problem with those stocks that have had such runs is they're very extended from their 200-day moving averages. So they can actually pull back quite a bit and still be within the definition of a long-term uptrend, but cause a lot of pain in the short term. So those sorts of overextended names, I think it's tough to justify, adding a position today when a name has already had such a run. I'm more inclined to look for names that are earlier on, and what I look for are what are called big base breakouts. Something like a Murphy USA comes to mind as a good recent example where you had a sort of sideways pattern, a consistent resistance level, and then it just finally breaks out. And there are a lot of patterns like cup and handle patterns and other names that really try to identify those stocks that have been sort of sideways and are just starting to break to new swing highs. When I'm looking for 3-month highs, that's sort of the actionable move that I'm looking for. And I would try to find things a little earlier on in their uptrend as opposed to the ones that are a little more mature.
Okay. What about non-stock assets here? I mean, anything you'd say in the charts you're seeing for, something like the TLT for interest rates, or even gold or Bitcoin, some of these things that are getting a lot of news these days?
Yeah, so it's interesting. I mean, if you told me that the Magnificent Seven group of stocks were doing as well as they are, and that the indexes are not too far off of all-time highs, I would probably not hazard a guess that gold is right at a new high as well. But that's the reality. And I think when you're thinking about the market environment here, where we have a Fed that is now talking about changing the interest rate policy and starting to do rate cuts later this year, that really starts to change the configuration of this market. And if inflation, changes in terms of how big of a concern that it's been really for the last 12 months, it's been top of mind for many investors. If the Fed really is getting it done, and if inflation is becoming less of a concern, and if they can start to lower rates, I would not guess that gold is doing as well as it is, but it is. And so I think what you have to remember is if stocks are a little overextended and if they do enter into a corrective phase, it's often helpful to look for what are called uncorrelated assets. Yeah. And what that means is basically what moves differently than stocks. So if stock starts to sell off, where can I expect a differentiated return? Something that's going to look different and hopefully not be as bad. Two things I immediately think of are gold, which are $2,100 an ounce, above $2,000 an ounce. I think is a pretty constructive setup, and overall, the long-term chart, the weekly chart, looks quite strong there. And then cryptocurrencies, particularly Bitcoin, we're near sort of that Bitcoin halving, which if you look back in the short history of Bitcoin halving actually tends to be a pretty bullish outcome. I think 100% of the time it's gone up afterwards, and we're sort of right at that point. So I think there are opportunities to diversify away from stocks, and particularly if you're sitting on significant gains in some of those growth stocks, there could be an opportunity here to differentiate to other areas of the market that could provide some upside if stocks pull back a little more.
Perfect. So I guess, as we get towards the tail end of this conversation, I mean, if you had to name one thing that really stands out as probably a pretty good buy here, and maybe one thing that was in your penalty box or your sell zone, what would that be?
Ooh,
it could be a group, it could be
question.
A name, individual, I don't know.
Good question. I mean, for a buy idea, I mean, I would probably say Homebuilders better than anything. And we talked a little bit about, the charts overall are quite strong. While they've had pretty good runs, they've recently consolidated. So if you are going to buy things that have had pretty good runs, it's usually good to wait for some sort of consolidation phase, which sort of an equilibrium, buyers and sellers are even, and then we start to change. And you're seeing a lot of those Homebuilder charts now just start to emerge, some of them from nice consolidation phases. I would also say if the Fed does follow through with rate cuts, which seems like a foregone conclusion, that's going to make houses a lot more affordable. And you're seeing a lot of a bid higher on anything related to a home. I mean, things like Home Depot and Lowe's having a nice bounce, given the expectation that people are going to be able to buy homes a little better. It's just going to be less expensive. So I think that's a good play for playing the Fed, and also just the technical setup is pretty strong. Things that I would avoid, to be honest with you, are growth stocks where you're seeing divergences. Apple's probably my favorite, short idea at the moment, because I think, names like that feel like they're never going to go down again. The reality is what we've seen with Apple, what we've seen a lot of the mega cap names, there's significant regulatory pressure that's always a threat. And we've seen what happens when there's an announcement of, okay, there's this big antitrust legislation. I don't think that's the last one we're going to see. And that that's going to weigh on these names. So the risk to big, dominant mega cap growth stocks is that regulatory pressure starts to come down. So I'd be lightening up in those areas. And again, looking for sectors of the market that have been underappreciated, like home builders, maybe even things like basic materials that are starting to break out earlier on in their breakouts.
Awesome. I guess to wrap things up, you're going to be speaking at our Investment Master Symposium conference. It's in the Bay Area in May. And, the event's several weeks away, so you never know exactly what you're going to talk about. But you have topics like the most important chart of the day and 7 questions to ask before every trade. Any little bits of or nuggets of wisdom you'd like to tell people that, they can expect to learn about there, kind of methodology oriented?
Yeah, I'm super excited for the event, Mike, and I'm thrilled to be a part of it. To be honest with you, I'm going to do 2 different sessions, and they really focus on practical routines and really how you make decisions. I find so often as investors, we, sort of gravitate to whatever we hear about. We hear an idea, we just kind of pull the trigger, and there's not a lot of discipline in that process. Institutional investors, money managers that I've worked with have a very well articulated process. They have checklists that they follow when they want to add something to their portfolio or when they want to take something away. So my goal with an event like this is to encourage individual investors to use that sort of rigor in their decision-making process. When we talk about the most important chart of the day, it's really going to be talking about how you spend your time during the day as an investor. What's the first thing you look at? What's the order of operations to make sure that you orient yourself to what I call situational awareness for the markets? So you understand what's happening and you can identify ideas earlier on in their moves. Then I'm going to be doing a masterclass called 7 Questions to Ask Before Every Trade. I'm actually going to share with you the checklist of 7 items that I follow for every buy decision or sell decision in my portfolio. We'll look at some examples together and hopefully to leave people with some practical ideas of how they can improve their own decision-making in their own portfolio. So I hope they find it helpful.
Okay, awesome. I'm sure they will, David. I really do appreciate you taking some time out to chat here. Viewers, if you want to hear more from David, and again, not to mention dozens of other top trading, investing, and economic experts, I do encourage you to check out that Investment Masters Symposium in Silicon Valley and Burlingame. It's scheduled for May 7th to 9th at the Hyatt Regency San Francisco Airport. You can find out more information by clicking the link in the video description below. David, thanks again for your time.
Thanks, Mike. Good to see you.